Welcome to this YouTube video about the death cross trading strategy. We'll provide you with examples of death crosses and the historical significance of the death cross indicator strategy. How does the death cross indicator work? The death cross is a technical indicator that strikes fear into the hearts of traders, and for good reason, it turns out. Stick until the end if you want to find out how much damage a death cross makes. It's accurate to pinpoint when you don't get poor results by being invested in stocks. In this video, we'll be exploring what the death cross trading strategy actually is, how it works, some death cross examples, and most importantly, why it signals a kiss of death for equities. While it doesn't signal a bearish market, it shows that you get poor returns after a death cross. So sit tight and get ready to learn all about the death cross and how to avoid getting caught in its deadly grip. Let's start with explaining what a death cross is, how to calculate it, and how you can identify this bearish indicator. A death cross involves two moving averages, one short and one long. When the short moving average crosses below the long one, a death cross is formed. Which time frame is used for the death cross, and is it a lagging or leading indicator? We only use daily bars for the death cross, normally the 50 and 200-day moving averages. The death cross is a lagging indicator, meaning it reacts to events after the price action has taken place. Thus, when the 50-day moving average, the red line, breaks below the 200-day moving average, the blue line, a death cross is formed. Let's move more systematically into the death cross moving averages and backtest to see how accurate the trading strategy and indicator is. So, how well does it perform in a backtest? When we put in the trading rules in our platform, we get the following equity curve since 1960 for the death cross pattern. Okay, so what are the implications of a death cross indicator for the stock market, and how long does a death cross typically last? The performance is flat, indicating you had made almost no money since 1960, even though you're invested 30% of the time and stocks have compounded at 10% annually. Can we determine now if the death cross can predict market downturns, and how often does the death cross occur? There have only been 32 death crosses since 1960, but it proves that a death cross is a temporary kiss of death for equities, which means it's a bad time for stocks. What are the limitations of the death cross indicator? The drawback of a death cross indicator strategy is that it's not a sure thing, and you might want to be careful of staying outside the stock market for a long time because of the long-term positive trend. Is the death cross indicator more effective in specific markets? You might wonder if the death cross strategy can be applied to other asset classes such as stocks, ETFs, cryptocurrencies, Bitcoin, CFDs, Forex, or futures. And the answer is yes. However, you need to backtest each asset first. Are there other indicators that complement a death cross? Not really. The death cross is simple, but we've backtested other ideas and we've not managed to improve it. In trading, doing it simple is most of the time the best thing to do. Some readers might also wonder what the historical success rate is for the death cross indicator. Despite being a signal of weak future performance until the 50-day moving average crosses the 200-day moving average, the success rate, or win rate if you like, is pretty high at 75%. But this shows that success rate is not really that relevant. What matters is the average gain per trade, not success rate. The opposite of the death cross is the golden cross, a topic we've covered in the next video coming up right after this one. You might pay attention because the golden cross is exactly what it says, namely golden. Please like, comment, and subscribe if you like this video and want more similar videos. It helps us grow our channel. Good luck trading!